All right, I want to take a look at the equity put call ratio. That's because that's something that our next guest is watching very closely. That is Randy Frederick. He is Charles Schwab, Vice President of Trading and Derivatives. And Randy, in particular, you're looking at the equity open interest put call ratio at its lowest level, going back, to April 2009. So when you
Right.
get that kind of extreme reading, what are we to make of that?
Well, what's really unusual about it right now is that generally what you see is that put call ratios, whether they're based on open interest or volume, tend to move up and down with the broader market. So as the market gets higher, the put call ratios tend to increase, which kind of makes some sense because essentially what it means is people are adding hedges so that if there's a downturn, they'll be prepared. We see a very unusual thing happening now. As you mentioned, the put call ratio, the open interest put call ratio on equities right now is at about the same level as it was 1 month after the market bottomed back in March of 2009. So again, typically you would have a very low ratio when the market is very low. And then if you track the corrections and pullbacks that we had in the last 11 years, you generally see the put call ratio either at a bottom or close to a bottom, or I should say at least at a near term low when you have those dips in the market. But right now we have something completely opposite going on. The market is a fraction of a percent, may even be at an all time high by the end of the day today, and yet we have this ratio at a record low level. That is a big concern for me because what it tells me is that equity options traders, which have a large retail component, are exceedingly bullish right now, and they are not prepared and not ready for, and will probably get hurt by another downturn. That doesn't mean that it will cause a downturn, but it means that no one is expecting it, and that's usually something to be worried about.
And Randy, to that end, why do you think traders continue to ignore mounting bad news? We had retail sales data out this morning, wasn't too good. We've had weakness in consumer sentiment numbers, hasn't been good. Jobs data hasn't been good. Why do they keep buying into this bad news?
Well, I would say there's two key reasons. The first one is that most investors have been handsomely rewarded for buying the dips, at least over the last 10 years or so. Even when we had a very large dip earlier this year, which was actually a bear market, those who bought that bear market, who bought anywhere near the bottom, have been very handsomely rewarded in less than a year. I mean, market's up 50% in just the last 9 months. So there has been good results, and people will continue with those patterns until those turn sour, until something goes wrong, until we go into an extended bear market. And here's the key, and I'm not predicting that, but here's the other thing is that because it has been 11 years since we've had an extended bear market, anyone under the age of 30 really hasn't lived through that. If you've been an investor in this market and you're under the age of 30, you really have not gone through a bear market. The bear market we had this last spring was an anomaly because it was a month long. The average bear market lasts about 16 months. If these investors experience that type of a market, and again, I'm not predicting that, then I think they will change their tune. But because they have not experienced that, they become excessively bullish. You could use Alan Greenspan's irrationally exuberant if you want. And that's a plan that works and works and works until it doesn't any longer. And I don't know when that will be, but they will also get hurt when these small pullbacks occur. But I suspect once they do, they'll probably just buy the dip one more time.
Hey, Randy, great to see you. Just thinking about the bond market, another thing that just about anybody under 30 hasn't ever really experienced, at least as an adult, is interest rates. 10-year at maybe 4 or 5%.
Right.
I think he headed to the Fed today from the FOMC meeting. It might be a placeholder meeting, but what do you think might happen today at 2:30 p.m.?
Yeah, I think you're right. It is a placeholder meeting. I don't think anyone's really expecting any changes in rates, certainly. I think what we might get is a slight change in guidance from the Fed, maybe a little bit of a hint that they might be looking at buying some longer-term treasuries to keep the long end of the curve from rates from going too high on the longer end. We have seen rates creep higher. There are plenty of people expecting them to be somewhere in the maybe 1.25% to 1.5% percent range sometime early next year. So the Fed may be hinting at trying to control the curve a little bit to keep it from getting too steep. That's probably about the biggest news we could expect out of them. But we'll kind of have to wait and see. I don't know that the markets will react a lot. They probably will react right when the news comes out, right when the statement is issued. But generally that lasts like a half an hour or even less, sometimes only a few minutes.
Randy, finally, I do want to ask you about Bitcoin, which seems to be sort of going hand in hand with some of the other trends you've been talking about, younger people sort of driving some of the market action here. Still, I mean, it's not insignificant to see it now push up to 20,000. What do you make of that? And do you think even though Bitcoin doesn't really seem to correlate consistently with anything, do you think if we see a pullback in equities that some of the same factors will also drive Bitcoin maybe down as well?
Yeah, it's possible. Bitcoin's a tough one because, again, there's no CEO, there's no board of directors, there's no dividends, there's no revenues. It's kind of like a precious metal in many ways, although it's not been perfectly correlated to gold either, at least not at the moment. It has been in the past, but it hasn't now. Its value is simply derived on what people think its value is. One of the things I think that has helped Bitcoin a lot recently is that it has received some pretty solid endorsements from some very long term, very experienced and successful hedge fund managers and others who have now said that they have positions and that they think it may be worth buying. Those sorts of things I think do help because then it becomes a little bit more mainstream instead of just a fringe investment. But it is driven a lot also by, again, younger investors. Many of the older investors out there don't even really understand it or how it's done. I think some people have some knowledge of blockchain and how it all works now, but many people are uncomfortable. People in my demographic are uncomfortable with the idea of transacting in a currency that isn't really controlled by a bank or a central government. Because if something goes wrong, what do you do? But I think that's a big driver. But certainly some endorsements, and it's become more credible, I guess. And I think that will continue to at least keep it on people's radar for a while.
Yeah, I mean, I think some of the younger people probably don't understand it either, but that doesn't stop them from buying. Randy, thank you so much. It's always good to see you. Randy Frederick, Charles Schwab, Vice President of Trading and Derivatives. Thank you.